Hey, welcome everybody to this live chat. I am your host, Joseph Frankie. We are doing our weekly financial update that we do. We try to do it every week on Fridays on YouTube. Sometimes we miss a few weeks just because of how busy we are. So thank you for joining us for this weekly update. We got some stuff on student loans, mortgages, and the stock market. Of course, everything that we do pertains to young professionals, right? So that is who we're going to be targeting, 20 to 40 years old. This stuff's all relevant to you guys. Let's start off with student loans first, because that's what we deal with most of the time, because that's the number one problem that most of us face that are younger, right? So the big news coming out this week is that Nelnet is laying off a ton of employees, okay? Why is this a big deal, even if you don't have Nelnet? I'm going to explain that. Okay. First and foremost, if you have Nelnet, obviously you might be being switched to loan servicers. Okay. And actually, let me back up and explain that. They're firing people because they're losing 1 million accounts. Okay. That was the news. I apologize for that. Sorry, kind of confusing there in the beginning. Nelnet, the Department of Education said that they're going to be transferring 1 million accounts away from Nelnet. The reaction was that Nelnet said, well, shit, we're going to have to fire a bunch of people. Okay, so they fired a bunch of people. If you have Nelnet, obviously that means you got to see where your money's going at, right? You got to be heads up on that. The other side of that, though, is that even if you don't have Nelnet, we have seen that this might still happen to other loan services as well. Like the Department of Education has said that they're probably going to be moving accounts on a number of different loan servicers. So have a heads up on that. And obviously you have Nelnet. Don't be surprised if your loans get moved elsewhere. Why is this such big news though? First of all these loan servicers are understaffed, greatly understaffed, okay? When student loan repayment starts, it is going to be a cluster when these things kick off. It's not going to be pretty, okay? I'm just picturing the whole times already of people sitting there for hours on the phone because they're understaffed. I mean, they've always been understaffed and they're even worse now. Okay. The other issue that this brings up is how fast are you going to be able to get in contact with the loan servicers and do stuff and get stuff done once these loan repayment plans actually kick back in? Okay. That is one of the big reasons why you should start planning on this stuff now, is to say, look, what do I need to know? And can I do what I need to do without having to go on to my loan servicer and call them? Like, can I do it through studentaid.gov? Can I do it on their website? If I want to apply for this type of loan, what do I need to do? And maybe you call them now, so that way you don't have to wait hours and hours and hours on the phone calls. Okay. Not only that, but think about it, okay? Prior to COVID, there was 2 major mistakes that we saw loan servicers make all the time. First of all, those of you that are paying off loans, we would see them misallocate payments all the time. How do we know about this stuff? One, they're getting sued for it. But 2, we would also see it with some of our technology that we have at FitBUX that we built out, that you can actually track and see if it's being applied correctly or not. So we saw all these errors that prepayments were not applied correctly. They have less staff now than they did then. What do you think is going to happen? Like, do you think they're going to be better at making those prepayments? I don't know. I don't think so. That's just my opinion. Now, the other thing they would do is, like, if you're on an income-based repayment plan, specifically if you're married, this happens all the time. They'd miscalculate what your monthly payment is. So you think that's going to get better? I don't think so. Again, we would see these things because our technology tracks it, and that's what we would see. So just a heads up out there. One, your loans might be being switched. If you have Nelnet, they might be being switched because they already announced it, but it might also be happening with other servicers as well. And then they're laying off a bunch of employees. Wait times are going to suck. I think the actual service side of it is going to suck. I hope I'm wrong, but we'll see. With my experience with loan servicers, I don't have too much faith in them. Okay. So That's the big news on student loans, especially if you have nailed that. But even if you don't, you still got to keep an eye out. Okay. Now, other parts I'm going to talk about today, just real quickly with the stock market, because I got this question last week. First of all, the stock market's all over the place. Like today, it's up, or this week it's up 2.2% or something like that. The market hasn't closed yet today. It's this as of Friday, but it's up for the week. On the year, it's all over the place. 3 weeks ago it was way down. Now it's all over the place. And I constantly saying these things. Dollar cost average. If you're managing your money, dollar cost average, especially in like IRAs and all this type of stuff, because I've had a lot of people come to me and be like, well, the market's going down. Everybody thinks it's going to go down. So we're just going to go turn around and we're not going to invest right now. We're going to wait. Okay. Why should I keep putting money in? Okay. And so when I say dollar cost average, somebody asked me the other day in a DM, they said, can you give us an example of why dollar cost averaging can actually work in our favor? And it's like, yeah, I can do a quick example of that. I'll just take the last 2 months because the market's been all over the place the last 2 months. Okay. Let's just say that on February 1st, you're putting $1,000 a month into accounts. And you just said, look, I'm not going to put any money in this. I'm going to just throw $9,000 into this all at one time. I'm just going to put it all in. Between February 1st and today, that $9,000 would have gone up to $9,020.32% return. All right. That's pretty good returns for 2 months. Okay. Like pretty decent year. If that was annualized, not too bad. But let's just say you're like, look, I'm not going to try the time to market. Instead of putting $9,000 in or not putting anything in and just waiting, I'm going to put in $1,000 a week. So every week you put in $1,000. That $9,000 that you put in total, because that's 9 weeks from February 1st to today, you would have put in $9,000. It would be worth $9,161. Okay. What does that mean in percentages terms? It would have gone up 1.79%. Versus if you just put all the money into the market all at one time, it's 0.32%. Or worse yet, if you're like, look, I'm going to try to time the market and you never put it in at all, you would have been at 0%. Okay. So that dollar cost averaging, had you have done that instead of putting in a lump sum in, it's over 560% higher returns during that same time period. And the big thing about investing is that you can't try to time the market. That's like the worst thing you can possibly try to do if you're managing money. If you're an investor, that's something different. Like I always say, that's a full-time job. You're trying to time everything, all that type of stuff. Money management, you're just trying to get a return. Maybe you move your allocations around, but with money management, you're trying to dollar cost average. That's an example of how effective dollar cost averaging can be when you're just constantly putting the money in and not trying to time the market. Okay. So I want to give you that example. Maybe I'm probably not going to do it in a weekly update. I'm actually probably going to come out with a whole nother video and podcast and articles and stuff about dollar cost averaging and actually show you guys like over a 10-year time span, what happens with that. What happens if you missed like the top, 10% of days because you're trying to time it, what happens? There's a lot of studies like that, but I'm going to come up with my own example and I'm going to extend that time period out to show you guys, why dollar cost average, what does it do? But I just want to give you that quick example on this weekly live chat because I get that question quite a bit is, can you come up with an answer? Because I've been saying that since like September of last year. Like if you're managing your money, just 401k, I think the market's going to go down, but you can't time stuff because eventually it's going to go up too. So dollar cost average, right? That is, the news pretty much on the market. Same news as before. Dollar cost average, things still don't look pretty. Numbers don't look pretty. Somehow the market's still being resilient. Like I wouldn't have expected it, but it is. And so that's where we're at. Home ownership, getting a little bit more affordable out there. I know 2-3 weeks ago, mortgage rates peaked out. The national average was about 7.13%, about right around that area. Right now, the national average is about 6.85%. So coming down a little bit, it's still high. I mean, going into January this year is around it dropped down to about 6.3%. So we're still way above that at 6.85%. Long story short, home affordability, in my opinion, still sucks. You got Scheller, who's known to be, he's really known in the industry because of the Case-Shiller Index, very popular guy, Robert Shiller. He even came out in the news saying that he expects housing to drop quite a bit over the next probably 6 to 18 months. We'll see. We are starting to see some declines, across the country. Just again, every market's a little bit different. How much down? I did the update a few weeks ago saying that, like in my area, we had to see about a 30 to 35% drop based on those 7% interest rates. So we're only down to like 6.85% from there. So when you talk about affordability, you'd have to see probably a drop between 25 and 30%. And we're at probably about 15 to 18% drop where I live. So I think it's got some ways to go where I live at, where you live at. If the market hasn't dropped, I maybe it wasn't priced in to begin with, but I think that you'll see some drops coming up here soon. But like I always say, if you're doing this stuff for long term, you find your forever house, it's fine. And then if rates drop, like after you buy your house, refinance out of it and get the lower rate. It's different if you're trying to do investments and doing like short term type of like home ownership type of stuff. But I just think, the housing's got to drop just if at the current interest rates where mortgages are at, just because, the home affordability sucks. The only reason why we haven't seen major drops is because inventory is still pretty low, historically speaking. So that puts a floor on it. And I will let you guys know, we were supposed to do a big real estate update actually this week. We put it on hold. If you guys are new to the channel, I do like a quarterly update with Josh Patel from Josh Metal, sorry, mispronounced his name, from Neil Home Loans. And so we're trying to coordinate time over the next week or two. Actually, over the next 3 weeks, sometimes it's just tough because I'm actually going to be flying a lot. So we'll see if we could get that on there. But mortgage rates are starting to drop. That's the big news. Still not dropping enough. We'll see in terms of affordability, but that's where we're at. So quick update today. Again, student loans. That's the big one in my opinion this week. Nelnet laying people off because they had over 1 million accounts being transferred away from them. So if you have Nelnet, your loans might be being moved. So keep an eye out for all that stuff. And even if you don't have Nelnet, that's the big writing on the wall. Be prepared when student loans kick back in. It's going to happen this year. Good probability that it happens this year. If not this year, it will kick in next year. So be prepared. That being said, thanks for joining us on the live chat. If you're listening to the podcast, thanks for listening. And we will talk to you guys next week.